recording. So this is Shane Handy with The Rational Trader. It's Saturday, September 8th, and we're talking about location-based models and then how the price action behaves at the low volume node and how that impacts us. So let me move this off the screen here as soon as it lets me. And what I want you to notice is, there we go. I need to stop. That's what I need to do. No, I did that wrong. I wanted to pause it. So we're going to have to reset that up again because I want to show you the volume profile itself, not just the lines, because the lines are a little abstract for some folks. So let's let this come back up, and I'm going to do this again. And then what we want to do is we want to notice that you can break the chart up into 3 distinct areas. Okay. And I'm waiting for this here. All right, so you're inside the value area, or you're outside of it, above it or below it. So let's pause this now. And if I look at, I should be able to move this now. Here we go. So this is the volume profile as it exists right now. Okay. Right here, do you see? It's the gray bars in the background. It's actually there's sort of like 2 little profiles. Okay. There's 2 distributions, I should say. This entire thing together is the volume profile at the start of the day here. Okay. And the value area is defined as the price levels where 70% of the trading has occurred. Okay, and so that's between here. That's what this blue line is. It's the top of that level, and then here's the bottom. Okay, so this is the value area low and the value area high, and what that means is that in between these 2 lines, 70% of the trading has occurred between these 2 lines. Okay, and this is called the value area. All right, and it changes as over time, and so this is why you see these blue lines and pink lines moving as the volume trades. The locations of the edges of the value area change because we're tracking where 70% of the trading occurred. All right, and when you're inside the value area, you're basically saying that buyers and sellers agree on the value of the security. Okay, and in fact, the point of control, which is this purple line in the gray bars, is the price level at which the most trading has occurred. So this is the place where the buyers and sellers have met the most. Okay, and we also track that through the day with this blue dashed line. So that also changes over time. Okay, now there's 3 obvious areas here. There's inside the value area, and then there's outside it and you're below it, and there's outside it and you're above it. All right, and the market behaves differently in these different areas because of the amount of trading that has already occurred in those areas. Okay, so it's not unusual at all to see exactly what you see here. If you look at this, this blue line here, you can see it's tracking the edge of the value area. Down here, we're tracking the edge of the low value area. And what you see is the market, it rallied up to the high value area, and that's where it stopped. And it came back down to the low value area, back up to the high value area. This is very common behavior, all right? Because what it's saying is that down here, or rather down at this level, the price is too cheap now. People aren't willing to sell down here. So you ran out of sellers. And up here, it got too expensive. People aren't willing to buy anymore. Okay. And so I said earlier, there's 3 distinct areas, right? There's inside the value area, and then outside it above, and outside it below. But there's actually 5 areas if you consider each of the edge as a separate area. Okay. And so I've got inside the value area, I've got outside the value area above, that's up here, outside the value area below, and then I also have this place here, this area here that is the edge. All right, it's the edge here, like this, at the low, and then there's the edge at the high. All right, and so what we're doing is we're saying, all right, I understand that the edges are areas where the market, it has to make a decision whether it's now too expensive or too cheap, and we're gonna move back into the value area, or if we're gonna break out and discover new prices. Okay, and so the way that the system is currently set up now is to make predictions at the edges, okay? And then it also makes predictions at the low volume nodes. So the low volume nodes are the places where, not a lot of trading has occurred, like right there. You can see at the time, in the same way that the value area high and low track as the market trades, I have written a custom study that tracks the low volume nodes as the market trades, and that's what these orange and red lines are. Okay, and so when you think about it, what it means is if we look at that spot right there where there's hardly any trading has occurred relative to everything else, it means that there weren't many buyers and sellers that agreed that was a good place to trade. And so it often acts as it's a decision boundary. Is that still true? And so the market will blow through it, or it'll bounce off of it. It's one of the two. If the dynamic has changed, then it'll start going sideways and it'll build volume there, and it will change from being a low volume node to being a regular node. Okay, so as we see here, this spot right there is a low volume. It's been a low volume node for a while. All right, and when the market got to it, it just blew right through it. Okay, it's still a low volume node here because it didn't spend any time at all. Just a little bit of trading occurred at this level. And so when we came back to it, the same decision has to get made by the market. Are we going to stick around here, or are we going to blow through it? Are we going to bounce off of it, or are we going to blow through it? In this case, we blow through it again. All right, and then we come back up to it again, and again we blow through it again. All right, in this case. Down here, the low volume node, you see right here, it's been a low volume node for quite a while. Here, we bounced off of it. Now that happens to coincide, in this case coincidentally, with the value area edge. Okay, so you've got these edges and you've got the low volume nodes. All right. And so what we currently do is we say, all right, if I'm at a low volume node or I'm at an edge, machine learning system, make a prediction using the price action patterns that we've defined as part of the sort of the original rational trader view of the market. All right. And so I really like what I see in terms of where we're choosing to get into the market. Okay. I don't want to be trading right here at the point of control. This is not a place I want to be trading. But I want to be trading down here at the edge. All right? And here. These are excellent places. When you look at the chart, you can go, yeah, that's right. That's the place to be looking to get into the market. It's either gonna bounce off that or go through it. The market's gonna make a decision there. So let's use the machine learning system focused on this area. Okay, so that's what we've done when I released the volume profile. I really like what I see, even in this really volatile times. It's still very nicely finding those places. Okay, as the market trades, we get low volume nodes inside the value area, and you get low volume nodes that are outside the value area. Okay. When we're inside the value area, sort of all we care about is how close are we to the point of control. If we're too close to the point of control, we won't trade. We have to be far enough away. You have to assume that the market is going to travel back to the point of control. And so we will not execute a trade if we're too close to the point of control. So this is a great example right here where there is a low volume node that's really very close to the point of control, and we will not, none of these bars get orange until you get far enough away from the point of control. Okay. Now, so with that preamble in place, there's two things going on that I'm working on. One is the way that we look at the price action is not sufficient now, since we're getting so specific on how we're targeting the location to enter. So an example is there a good example on screen? Probably the best example on screen is right here, where you've got to this low volume node and you're basically just blowing through it. I can tell you that the way the machine learning system is built, it's not going to make a prediction here. You're going to get back a 0 every time, because there is no price action pattern here that says anything meaningful is happening based upon the old way that we did it. Okay, we'll find some more examples in a minute, but up here at these edges, these are fine, because there's a lot of work. There's a lot of movement up here. So the system will see this test of that level and failure. So you're going to get predictions up in here. All right, but these low volume nodes are different. We're seeing, this is a good case as well. The market falls down to this low volume node and immediately just bounces off of it. That V bottom is not catchable with the existing set of price action patterns we look for. All right, and so I want to change that when I'm at a low volume node, and so that's what I'm working on the production system. The production system. The next refinement is I want to understand how to deal with this case here, where I'm at a low volume node and I'm just sort of bouncing off of it, or I'm at a low volume node and I'm just blowing right through it. All right. In particular, I want to catch these because these are really fast, fun trades. You get in and you very quickly are moving through. You see it all the time. All right. So on the production side, that's the next step that's going to get added, or rather, it's being evaluated to understand, is it valuable? Just because I see it doesn't mean that it is over time, right? It's too easy to see something that looks good, and you end up discovering that that only works once, or that only works for a couple of times. So I'm looking at the patterns of price action at the low volume nodes, and deciding how to capture that such that we get sort of the power of the machine learning system applied better at these locations. Both of these locations here are a good example where the machine learning system is going to tell you don't do anything every single time. This V bottom and this case where the market's just falling apart is just blowing through that level. But I want a prediction right there, and I want a prediction right there on that bar. I'm not trying to pick the bottom, but I can see that I'm at a low volume node and I was going down and now I'm going up, and I came at it from above. So this is what we see in the low volume node. You approach it from the bottom and then you bounce off of it, or you approach it from the top right here and then you go up there. So I can see some potential there to build into the system. Give me an order flow prediction in these cases where I'm approaching a low volume node from below and I reverse, or I'm approaching it from above and I reverse up. Okay. The third one is this blowing through, which is a little trickier to figure out exactly what that looks like. Exactly what, how do you, algorithmically, what does that look like? So, one step at a time here. Okay. So in terms of what to expect as the next refinement, it'll be that addition. Okay. There'll be specific codes associated with those, so you can, just like there are now, right? So we've got these codes here, right? So there'll be new codes here, so you could choose to use them or not, or you could choose to only use them and nothing else. That's how I test it, right? I'll create those codes and then only put them in, and then we'll run our back test. All right. So if you don't like this idea, it's not a big deal. You don't have to use it. It's very configurable. Okay, so that's the kind of the next thing that I'm trying to get out the door here. All right, so that in terms of what we wanted to talk about today was agenda item number 1. If we go back to here, location-based models is the other discussion point. So in the live trading room and on the videos, you saw a simulation running on the left here, which I didn't bother to bring up for today's discussion. And what's happening there is I'm experimenting more with the machine learning models themselves. So what we've been talking about is taking the existing set of the existing model that I use, and applying it a little bit differently at low volume nodes. Okay. The simulation that was running was taking this concept of the 5 different areas of the chart. So inside the value area, outside the value area and below it, outside the value area and above it, or at the edge, the high edge, or at the low edge. Those 5 different areas, and creating 5 different models for each area. In fact, I can show you, if I bring this up and show you, those of you that look at this file. Here's the YAML file for that simulation. You can see that all of these are different. Instead of just a complete model, you've got models for when you're near the value area high, when you're near the value area low, when you're near a low volume node and you're above the value area, when you're near a low volume node and below it, and then when you're near a low volume node and you're inside the value area. So 5 separate models. And the idea is that you give the machine, like for the value area high model, you give the machine just these bars. You don't give the machine any other bars, just those. And it trains on those, and it looks at the order flow patterns at the value area high only. And then separately, you create another model that says, here are the bars at the value area lows only, nothing else. So learn the patterns of order flow at the value area low. And then another model when I'm outside the value area and I am at a low volume node. Give me those bars, and just learn the order flow on those bars when you're below the value area and at a low volume node. And the same thing up here. And then the last one is, this case where you're inside the value area at a low volume node. Okay. And so the idea is, if there is a distinct difference in what the order flow looks like in each of these locations, then I'm going to get a better prediction at these areas than my complete model. And it's not clear if that's true or not. Okay, my initial test was, let me state that again, because this is the key to why this will work or not, or why this will be an improvement or not. If the order flow at the value area high, if those patterns look different, if they're consistently different than the patterns of order flow at the value area low, then this approach will produce a better prediction in these areas. But if it's just the same, then the current model that I'm using will be fine. Okay. If the order flow just looks the same in all these places, and then it doesn't matter what I'm doing here. Logically, it seems to me like they will look different, but I haven't proven it yet. Okay. But I took the first step, though, by creating 5 separate models. And then I had to customize the server to do that. I spent all of the last holiday weekend doing this. Okay. And so now I've got a framework in place to start testing that idea. Okay. And so I did that, and I ran some back tests, and they were not too compelling. All right. I was like, okay, that's not fundamental. It's not dramatically better. It's not dramatically worse. It's just kind of all right. But I did make some choices when I was doing that. And one of the choices I made was I said when you look at the daily chart and you look at the volatility in the current market, you can see, if we go back, I'm going to go backwards in time. All right, so this is beginning of February now over here on the right. And now let's squeeze it up just a little bit. And you can see that, kind of for the most part, your average has been down in the 50s or 60s. And you'd spike up now and again here, a little bit here. If you go back even further, it's even lower. Okay, just in terms of the amount of volatility in the market. And so my thought was, well, let me just make the model using data starting when the market went berserk, because it's still it's still really high. The volatility is still really high. So let's just use the volatile market data to build those models. Okay, and so I did that, and I ran it last week, and I ran back tests, right? So I built that model through, it was through 8:10, and then that let me run back tests for 3 weeks, right, starting on 8:13. Not a whole lot of days, just like 15 trading days, but it gives you an idea. The replays take so long that I have to reduce the amount of time. I have to reduce the amount of time an iteration takes. And so I wasn't horribly impressed with the results of those back tests. And then trading live this week, what I saw was that when we're kind of when we're in sync and hitting and doing well, that this approach does better. But then it does also much worse when you're not, and that's the opposite of what I want. Actually, I'd rather see less instances of max losses and lower profits on days when you're profitable than really big swings. All right, so I fully expect the amplitude of the losses and profits to go up when the market range increases, when the volatility increases, but I'm trying to damp down the losses, and I'm willing to sacrifice profits for that. And so this was the initial motivation for doing this volume profile based location trading. All right, so what I want to see is the opposite of what it showed me. So my next test here is to build models that use the entire set of data, not just the data from February 2nd. Okay. And then run those tests again. All right, now I don't think I'll be able to get to that this week because of all these other issues that I've been dealing with Infinity. I couldn't get in to get the data yesterday, not until really late last night. So just getting the regular production models out is a challenge this weekend. But that's the next step here, is to, okay, well, it appears that just using volatile data isn't better. So let's follow the normal principle of machine learning, which is that more data is better, and go back and build those models with all of the data that we would normally build. Going back to it's the beginning of 2016 is what we do right now. Is that right? No, the beginning of 2017. So we go back, it's like almost 2 years of data. So that's the next step there. Again, I don't think I'll get that done this week. So next week I'll be simming using the same model here. And then I'm also getting close to wanting to do something that we talked about earlier related to price, making predictions at low volume nodes, and that takes priority. So I'm going to do that first. And that's it. So that's where I stand right now. I'm working on, for the production system, no changes to that model, but changes to the way we apply it at low volume nodes. And then from a modeling perspective, trying to see if we can get a better prediction at each of these specific locations. And I have high hopes for this, actually, though it's a lot of effort to get there. Okay, so now would be the time for questions, of which there have been none so far. So originally, we weren't looking at volume profile at all, okay, and all we did was we looked at the price action and where it was relative to the midline. In fact, let me turn the midline on. If I can find it. Okay, so the only location information that we were using was, well, where am I relative to this line right here? This line right here. These lines, actually. All right. Am I above or below the midline? All right. And if I'm below the midline, I'll look for turning behaviors or pullback shorts. If I'm above it, I'll look for turning behaviors short or pullback longs. That's the only sort of location-based information we used, and the price action pattern is what you would use to help understand that the market is turning or not. So here, like right there, is a type 3 pattern long. We'd be looking for a turn long right there. Okay. As you get up to here, as you actually, let's go back a little bit. As you fell through that midline and then pulled back, you'd be looking for pullback short behaviors there, success or failure, and you'd be looking for turns long there. So now what we're doing is we're taking that same idea and saying, okay, but I don't want to do that just everywhere. I only want to do that in these specific spots at low volume nodes and at value area edges. And the problem is that when you're at a low volume node, you don't always, just given the way that we've built it to understand that we're near a low volume node, you don't always get all the bars you need for that price action pattern to have formed. Okay, and so the basic idea is, if I'm using the low volume node as a way to tell where I want to enter, then I don't need so much intelligence on behavior in the price action pattern that I'm using to make a decision on whether or not I should issue a prediction. Okay. Centralized server is still an idea that's out there, Dave, but I'm not pursuing it yet until I'm more comfortable that I've got something that's dealing with the volatility. All right. And or it kind of does what I described earlier, which damps down the max loss days, even if that's at the expense of profitability. This is a problem. This is the big problem we're dealing with right here. All right, this was insane. This volatility was absolutely unbelievable, but it hasn't settled down to anything close to what it used to be. So if this is the new normal, fine. We got to deal with that. So I need to get something that I'm happy with there before I can go to the next step and create a centralized server. Okay, the centralized server by itself is a huge project. All right, I like the idea, and it makes things easier for you, the user, and it gives me some options to do some things in terms of the business model that I can't do the way that we're currently doing it. All right, but I'm not there yet. I don't feel like I've got the system at a point where it makes sense to stop what I'm doing and instead switch to that. Doesn't running the 45 tick for high volatility and 30 tick for low volatility do what we need it to do versus combining all the data to create one model? All right, so let's make sure that we're clear. The thing that we call the 45 tick model and the thing that we call the 30 tick model contain all the data. They both use data that goes all the way back to the beginning of 2017. All right. Our response to increased volatility is to switch to a model that we call the 45 tick model, but really what it is it's trying to it recognizes that bigger range days, more volatility means more noise or more randomness, if you like that term better. There's more noise in the system. And so the 45 tick model is an attempt to help separate the signal from the noise in a noisier system. Okay, that won't change whether I'm using my current method or the location-based method. We'll both want to have cases where we are able to make that choice between sort of regular markets and noisy markets. Okay, there's another avenue to pursue which has the system automatically picking that, but that's a totally different project. Okay, so the 45 tick model is a choice that we make that says we think there's the markets are more volatile. There's a lot more noise in the system. Be more strict in how you you separate that signal from the noise. Okay, that's not going to go away, even with this more targeted location-based approach. There's still noise in the system. At least that's my current belief. In the testing I did, it was I needed to use a stricter model to get decent results in the current environment. If I used like the 30 tick model on my value area, on my location based models, it was terrible. I got killed. There's too much noise in the system. Here's how to think about it, and I don't have the visuals yet, but they're in my head on how to help you understand it. There is a spectrum between totally deterministic and totally random. Okay. All right. If this side here is totally random, okay, that would be equivalent to rolling the dice. Okay, that's totally random. All right, so if someone came to you and said, I have a machine learning system, I have an artificial intelligence system that will predict what the next roll of the dice will be, and you can use it to make money playing, I don't know, craps, shooting craps, you'd laugh in their face, because you know that rolling the dice is completely random. There's no way to predict it. There's no what happens next is completely independent of what's happened before. Okay. The other side of that spectrum is completely deterministic. Okay. Completely deterministic is if this happens, then this other thing always happens. So an example of something that's completely deterministic is gravity. If I throw a ball in the air, it's going to come down, and it's going to come down in a completely predictable way because the physics don't change. Okay, so somewhere in the middle between completely deterministic and rolling the dice is trading. Somewhere in here. Okay. Somewhere in this spectrum. All right. It's not completely random, and it's not completely deterministic. All right. And what I'm trying to communicate is that when the volatility goes up, this line moves more to this side. So in quieter markets, regular markets, you're more over here. But when the markets when there's more volatility, that's the wrong button. When there's more volatility, it's more over here. And when the volatility is insane, it's way, way over here. It's truly just like a crapshoot. Okay. And there's a little bit of a feedback loop here, actually, because the bigger traders know that, and so they stop trading, which just increases the amount of randomness in the market. So it tends to push itself as the volatility goes up. This pushes more and more and more to being completely random. It's why we used to go, there's no way I'm going to trade when the overnight range is greater than 100 points. That was our cutoff point where we went, okay, it's too insane to even try. All right, with the machine, we'll still try because the machine it's faster. But it can make a decision in time, and it has a full set of data across a couple of years. But the 45 tick model, what we call the 45 tick model, is trying to help us trade when we're living in this world over here, and we use the 30 tick model when we're living in this world over here. Okay. And when you're switching between is when it gets kind of difficult to tell what to do. All right. And so that noise in the signal is still present here at the value area edge. That hasn't changed. The overall randomness is the same across the entire range of the prices. And so when I'm looking at the value area high data, I still need to account for that noise. Okay. And the way I'm doing that now is by creating two separate models. All right. There are some other ideas about how to get it to adjust automatically in the model itself. That's much more sophisticated. And there's a much simpler way to just have the system itself pick the model based upon the overnight range for you. All right, that's just doing what we're doing now and automatically choosing. To me, that's almost not worth the effort. It's just easier for you to look at it and go, okay, this is what I want to do, and then do that. Okay. Moderately predictable, yes, John. Okay, so this, I think people don't understand this. They don't understand this spectrum. And I have in my head a way to visually help you understand that very clearly, but I haven't been able to create it yet. I just don't have time. It'll probably come up at the next Infinity webinar or something. But where you are in this spectrum is really important. And it gets more important the tighter your stop. Okay? So the bigger your stop, the more room you have to deal with the sort of the random fluctuations in the market. And as small account traders, our stops are about as tight as you can get and still trade. Other questions? All right, so for next week, what you can expect to see in the trading room is just what we had last week, which was the normal models running in the right, and then this simulated simulated location-based trading. There won't be any change to the location-based models. I won't have time to do it because of the other issues that we ran into on Friday, and so. In the background, I'm specifically working on looking at the behavior at the low volume node. Okay, so what will be coming is a change. It'll actually be a server change, and new codes for these cases here, where I'm at a low volume node, and I'm looking at the price action a little bit differently to take advantage of these cases here.